So I'm a hardcore Bitcoiner. Our show has tons of Bitcoiners that are listening in. And just to put it simply, I just don't trust the banking system because of everything that you've just described. This ever-expanding manipulation in markets to control fixed income and never allow creative destruction to actually occur is what we're really talking about. And in my humble opinion, we aren't operating in a free and open market these days. And when you look at the size and the quantity of like some of these decisions that are being made by a couple people in the room, it's kind of mind-blowing, and I just see trust breaking down. As a person that really understands the legacy banking system, do you empathize with Bitcoiners and why they're turning to other alternate solutions to storing their hard-earned capital? And just kind of what are some of your thoughts on like what this looks like from a systemic standpoint moving forward with this keyword trust?
Yeah, look, the entire banking system is effectively based on the assumption that collateral must hold its value. And the collateral of the traditional financial system is treasuries. Everything runs around treasuries. It's very simple to understand as well, Preston, because if you go to a bank and ask for a mortgage and ask for credit, they will price your interest rate on that mortgage, on that credit, on that loan, effectively based on where treasury rates are, plus a credit spread on top of it, right? So imagine also treasuries are the foundation of the repo market, where banks effectively exchange money with each other in a secured, collateralized way, and that collateral is, again, treasuries. So basically, you have to think of treasuries as the foundation, really, of the entire machine. And you can also see the reaction of the Fed here, Preston, because what was about to happen was that some banks that were under-regulated were effectively mismanaging their risk, and they were facing a deposit outflow which was very large. To service this deposit outflows, they were forced to sell their treasuries. The treasuries that the very regulators told them they could own because they were as liquid as cash. But of course, because of the interest rate hike, these treasury values were much lower. So they needed to take a massive capital haircut, capital loss to sell these treasuries. And at some point they found themselves insolvent. So what happens then is, if you leave this unchecked, it will generate a fire sale on treasuries, because more banks will find more losses on their balance sheet, more depositors will get nervous, they will withdraw deposits, and it will force a self-fulfilling mechanism where everybody has to sell treasuries to service these deposit outflows. So the Fed cannot allow this to happen, right? And it's basically, again, a system which is based on trust on the value of this collateral. And if that goes away, the whole system implodes. So what the Federal Reserve does in this case is comes to the rescue, and it says, ladies and gentlemen, this collateral is worth 100. You bought it for 100. It's 100. Just give it to me. I don't care whether the price is 60, 70, 50, or 80. I'll take it at 100, and I'll lend you money against that at par against its nominal value at 100.
That's yield curve control.
Wow. I mean, we'll talk about the difference between this QE and yield curve control. Yeah. There's a lot of mechanics to explain, but my first reaction is, wow. This goes to show how much the system is built on the stability of this collateral. Because think about it. In 2008, the main collateral behind the banking system was house prices. In 2007, we were lending against the value of the houses like there was no tomorrow, and we were over-leveraging the system with more complicated structures, and it was all based on one predicament. House prices in the US cannot go down, Preston. This was the predicament. As soon as the collateral value started going down, because house prices started collapsing, then you had a massive problem, because it generates a deleveraging of the system that cannot rely on the value of the collateral strengthening anymore. And you saw what happens, what kind of creative destruction, as you called it before, unfolds. But what unfolds from it is also political challenges. It's unemployment rate much higher. It's misery. It's nothing that a politician would want to see, because nobody gets re-elected if he's the one to pinpoint for the great financial crisis, right? So this incentive scheme you're describing effectively make it so that the policymaker's incentive scheme is to keep the value of the collateral stable or rising. And that's what the Fed has done. The Fed has basically said, give me the treasuries, I'll fund you at 100. So what happens then is a couple of banks go in and they're like, yeah, please, I'll do that because I'm in trouble. I mismanaged my risk. I used the treasuries. I didn't hedge the interest rate risk. You guys hiked interest rates. The value of the treasuries went down. I'm in trouble. Well, you're telling me I can ignore this reduction in value. I'll use the facility. So I'll lend you the treasuries and you'll fund me. What this means is that the Federal Reserve is expanding its balance sheet again, which is something that we didn't see for a while as they were engaged in fighting inflation, trying to keep interest rates higher, shrink their balance sheet. This has now changed again, and there are some differences between this and quantitative easing and yield curve control that we can discuss. But my main point is, as I told you before, the tagline is remember that your money is the liability of somebody else in the system. Choose whose liability do you want it to be. Now the tagline is the Fed and the system is predicated around the stability of collateral, and it is that important that the Fed has chosen to ignore the market value, ignore what is the market assigned value to these treasuries, and give them a value of 100, an artificial value of 100, just to make sure the system doesn't implode on itself.